But in terms of private wealth, Saudi Arabia is half of the private wealth, and that's important, and it also kind of reflects the reality that Saudi Arabia is half of the economy for the GCC. So perhaps it shouldn't be too surprising. Now, Islamic finance. There's obviously we could spend a long time on Islamic finance, and perhaps we'll do that in another session. But Islamic finance. Before kind of discussing how it relates to the Gulf, I just wanted to highlight a few things about Islamic finance, which perhaps make it a little bit more understandable to those who aren't familiar with it. You see, Islamic finance has a lot of technical terms to it, and the Sharia is a very rich body of law with jurists and scholars, and it's something that obviously is very deep and complex. However, if you look at the core principles of Islamic transactions, there are some principles which are fairly straightforward, and if you think about them, they make a lot of sense. But they have a profound impact on how people behave financially. So the first principle, which is really the most important, certainly from an Islamic investment perspective, is if something is immoral, one cannot profit from it. Seems pretty straightforward. But if you look at how many sort of teachers' pension funds are investing in, let's say, tobacco stocks, which I don't think a lot of teachers would want to invest in if they thought consciously about it. It's a very common phenomenon, even to the religious institutions, investing sometimes with general fund managers who don't have screens around the ethics or principles of their investors. So we have a simple principle in Islam that if something is immoral, you can't profit from it. So if you can't do something, for example, we're not allowed to gamble. So because you can't gamble, you also can't own a casino or be involved in the casino business because it's seen as an extension of the same activity. Another important principle, and this kind of relates to the prohibition of interest as it's understood, is to share a reward, one also must take a risk. And of course, any of you who've studied economics and finance will of course say there's no such thing as a reward without a risk, because that's just, you're only rewarded when you take a risk. The big difference from a Sharia perspective is that the risk must be endogenous to the contract. So the principle of credit risk, which is that you promised to pay me back $10, but you might disappear or you might not pay me, that's not considered a valid risk, because you treat the contract on the face of it as if it will be upheld. And that's the principle there. And again, we could discuss it much more, but I don't want to spend more time on it. Another really nice principle, which again is I'm from New York. I'm from Staten Island. So we have right next to Staten Island is Brooklyn. The Verrazano Bridge takes you to Brooklyn, and then if you're going from Brooklyn to Manhattan, of course, you take the Brooklyn Bridge, right? And so we the very famous saying about somebody trying to sell you the Brooklyn Bridge. So that's a scam, is to sell somebody the Brooklyn Bridge. And we have a rule in Islamic finance or Islamic transactions that you can't sell something you don't own, which again seems pretty intuitive. However, if you understand the kind of structure of option trading, you know that one of the fundamental principles of short selling, or the way short selling works, or what's called naked shorts, is when you sell something you don't own because you think it's going to depreciate in value. And that's not something we can do. And the fourth one, which is a very important principle, is that in any transaction, what's being bought or sold has to be very clearly defined. And this in Arabic excessive uncertainty is called gharar. And gharar is when you have again excessive uncertainty and not clearly defined goods being exchanged. And so I'll give you an example of that here, which is a game show that perhaps some of you won't remember because you might be too young to remember this, but I've seen this game show, this is Monty Hall's show about Let's Make a Deal. And if you remember Let's Make a Deal, remember how it works. So Monty Hall goes to the contestants and says, well, I'll give you $50 or whatever it was, $10, $100, whatever, and says, oh, do you want to keep the $100 or do you want what's behind curtain number 1 or curtain number 2 or curtain number 3? And of course, the contestant has no way of knowing what's behind curtain 1, 2, or 3, so it's completely a game of chance. And a lot of the more opaque financial instruments actually resemble this level of gharar or uncertainty, where one doesn't know exactly what one is buying or what one is selling. And so this is a very clear example of gharar. And if you look at the books of Islamic law, they'll give us these kinds of examples. So if someone says, I will sell you the contents of this box for 50 dirham, then that's not considered valid because you have to know what the contents of the box are. Anyway, so why do we talk about Islamic finance and Gulf Capital together? It's because the GCC is the biggest addressable market for Islamic finance. So you can see about 2/3 of the Islamic finance market is in the GCC, which is remarkable because the GCC only has 40 million people, which is about the same as the state of California. And the Islamic world has about 1 billion and maybe 1.1, 1.2, whatever it is now. So of that massive population of Muslims, the asset pool for Islamic finance is heavily concentrated in the GCC. And it's interesting here, what I've done is, the way I've sliced this data is around what I call the addressable market. I mean, one very big market which is considered Sharia compliant is the Iranian banking market, right? So Iran, after the revolution, introduced a sort of mandatory Islamic banking, done differently from how it's done elsewhere. And it's not a market that we, who work in international banks, are involved in. So I've never had any dealings with Iranian banks, and obviously there are a lot of barriers to that. So one interesting thing is, if Iran, depending on what happens with Iran, but if Iran gets more engaged in the global financial system, then it becomes a big piece of the Islamic finance market. But for practical purposes, for Western in entities, it's kind of an off-limits market. So it's not really part of the market size from our perspective. The landscape, this is, again, more detail than you need, but just to give you a flavor for it, within the Islamic finance sector, there are 4 kinds of institutions. There are local banks, and these are the most common institutions, and these are the ones that collect the deposits and have been sort of the lifeblood of the industry. You've got some regional banks. So you've got banks that participate in multiple markets, like Masraf al-Rajihi or Rajihi Bank, Dubai Islamic Bank, and Kuwait Finance House. So these are institutions that have started in one market and they've expanded to others. And then you've got your multinational banks, like the one where I used to work, HSBC, where they've entered the Islamic finance sector in a very serious way. And they compete very strongly. And they have different strategies and different outlooks. And then you've got a whole set of specialist institutions, which are not banks, but rather financial companies or investment firms. And this category is quite an exciting one in terms of innovation. So what often happens is you'll see a small investment house will come up with a product or an instrument, a structure. The multinationals will say, well, that's an interesting structure, let me replicate it and distribute it through my network, and that'll happen for a while. And then the local banks will catch on, and it'll become a kind of a mass market product. Now, Islamic finance, how many of you have sort of studied or read about Islamic finance? Just a few. Well, then perhaps this won't be as relevant for you. But one of the big questions in Islamic finance, which the more you read about, I think the more you'll come across, is what I call here an authenticity challenge. So as Islamic finance has grown in market share, a lot of the products and structures that we've introduced as an industry are less sort of consistent with the spirit of Islamic economics and Islamic sort of transaction guidelines. And the reason for that, but that's something that a lot of people, some of the best writers on Islamic finance actually comment on this a lot. And they have a good point, they have a valid observation. But what one needs to recognize from an industry perspective is that there are a lot of factors that drive this trend. And the biggest and most important is customer expectations. So customers want, and we found this time and time again, that if you give them 2 products that perform the same, and one of them is Sharia compliant and one of them is not, they'll choose the Sharia compliant one, which is pretty rational. But if you give them a product which you say is Sharia compliant, but it doesn't perform the same way, they'll say, well, why should I pay more, or why should I receive less, just for being Sharia compliant? So I want something that looks like a duck, quacks like a duck, but's not a duck. And we can do that. I mean, we can synthesize things that look like a duck and quack like a duck, but they're not a duck. But in doing so, what ends up happening is the authenticity of the industry gets questioned. So people say, are you really doing anything, or what you're doing, does it really achieve the spirit of the Sharia? And that, I think, it's a fair question. And there are also, as I said on the slide, the competitive pressures are there as well. So, I mean, we saw this very clearly at HSBC. There were certain products that we didn't feel all that comfortable about. But then when we saw our competitors coming out with a product, it was very difficult to go